The Consumer Bankers Association is pleased to welcome you to today's webinar, Efficient Acquisition is Not a Marketing Problem, presented by Curinos. My name is Isabella, and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions to the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Sarah Welch, Managing Director at Curinos, and Brandon Larson, Chief Advisory Officer at Curinos. Sarah and Brandon, welcome.
Great. Thank you for having us.
Thank you. Great to be here.
Well, perfect. So today's conversation, we're going to really focus around retail growth and particularly how do we drive efficient acquisition, and honestly, what does that even mean and how do we do more of it? So I think a lot of you know Curinos really focuses on cross-bank data and analytics and really driving better data and insights into one, making better decisions, but then two, actually driving actions for institutions as well. So, out what we're seeing in the space. So with that, might dive in to page 4 to just talk about what we're seeing from an industry situation standpoint. So for one, across the industry, what we're right now seeing is cost per account from a marketing standpoint has continued to go up over the last several years. So when we look at switching behavior and new people opening accounts, we've seen that relatively flat as marketing spend across the industry has actually increased, which means that the marketing CPAs have actually gone up. At the same time, when we look at the customers that we're then getting to open accounts, we're actually seeing more fragmentation. So what that translates into is we're getting lower balances than we did historically. We also have customers that have multiple relationships. So half of the people who opened an account actually have 4 or more checking relationships, which was only about 7% in 2019. So you see this continued fragmentation, people having more checking accounts, and therefore this concept of primacy is actually getting challenged a lot. The other thing I would just call out here is when we look at some of the demographics, affluent customers actually have more banking relationships on average than mass market. And in particular, as you think of the different dynamics associated with opening a new checking account or even this concept of primacy, we're seeing that continue to fragment as well. And that I might have a accumulation account, which is where I actually grow my balances. That might be tied to a high yield savings account somewhere else. I might have a disbursement account that I actually have my direct deposit come into, and then I push the money to other spots, including maybe to that accumulation account. I may have something tied to my mortgage, and therefore I'm starting to accumulate these different sources. I might have a payments-oriented account. And so this concept of primacy is starting to fragment as well. And so it becomes really important to just understand who you're acquiring and what they're using the accounts for as well. One of the pieces that we look at across the industry as well is this concept of growth. So across the industry, we consistently ask people, what is your retail growth objective? The most common answer we get is net growth of 3%. We then ask, is that account growth or is that balance growth? And they say yes, right? So the challenge is people kind of just assume they're going for 3% on both of those things. What you'll see in the top right corner here is only about 10% of institutions are actually successfully hitting that watermark. And the the frame we like to remind folks here is population growth in the US right now is 0.5% to 1%, depending on the geography in which you're in. And so if you're truly going for something higher than 1%, or higher than what our current GDP rate is, you're going to have to take share from people. And so that's why you see that only about 48% of institutions actually are net positive on both customer and deposit growth. And therefore, for a lot of folks, it's really getting clear on what is the objective function, what am I trying to achieve, and what are some of the trade-offs that are going to be required in order to actually accomplish that. Great. So with that, we wanted to actually jump into a poll and just get folks engaged here and starting to ask some questions as we look to kind of tailor the conversation throughout. But we're wondering what kind of growth you're optimizing for at your bank. Is it we're really focused on units, even if it means lower balances, we're focused on unit growth? Is it that, hey, we're really much more focused on balances, we have a funding objective, and therefore that's where our focus is? Or is it that we want both, and you within your departmental objectives may have a focus on either customers or balances that is, part of that equation. So just curious if folks can kind of share where your objectives lie typically and what you're optimizing for. We'll maybe give it 20 more seconds, and then the other comment I might make throughout is as we go through in the next couple sections, Sarah and I are going to try and make this a lot more conversational. If you have questions, we're going to do our best to kind of address them as we go too. So please feel free to use the Q&A area. We will try and pay attention to that, but appreciate any engagement from folks for sure.
Brandon, can you hear me?
Now I can, yes.
Okay, great. Perfect. So it's looking like the answer is yes, as largely, right? It is what we're seeing in the poll results, that tension between growing deposits and growing households or customers is everybody wants to be in that upper right-hand quadrant where they're growing both of those things. And I think that if we jump to the next slide, the thing that is, interesting is there are a bunch of these kinds of trade-offs when we're thinking about customer growth. And acquisition is one part of that equation for sure. But in addition to do I want deposits? Do I want customers? Which, depending on which way you go there, right? I could do a CD campaign that's going to drive balances, but probably not do a whole lot for increasing my net core customer kind of count. Or I could do a big acquisition push around checking and primary relationships and build that sort of new franchise growth, but not really grow in the near term the deposits quickly. On, what beyond that sort of trade-off, there's the question of, okay, well, where do we even point our growth engine? Do we deepen with existing customers, which is often where your fastest path to near-term balance growth actually is. Acquisition is essential, though, for building the base that enables you to connect with the customers and deepen and grow balances with them over time, right? And most banks that we engage with, and it looks like from the poll, right, don't have an explicit answer as to which one should I fund when I can't fully fund both. And it's just another trade-off in this growth equation. And the last, big one that we see a lot around is the segment, right? Which segment should we focus on? The mass affluent customers are going to bring in more immediate balances right here and right now. But your mass market customers do have what we call a graduation effect, right? Where a meaningful share of them will grow to become highly, highly valuable relationships over a 3-year or a 5-year period. But trying to figure out and parse that future path today is really challenging to do. And I think the honest observation is we look at these trade-offs and we think about them and we think about the growth agenda as a marketing problem. We would tend to maybe live more on the right-hand side of this grid. Acquisition, awareness, response rates, CPAs, and thinking about that, as the core job. But these trade-offs aren't marketing trade-offs, right? They're enterprise strategy trade-offs. And that is a really important distinction for how do you go about deciding and making these choices. So on the next slide, in thinking and sort of double clicking on if this isn't just a marketing function, like how do the different threads of the organization come into this growth agenda? And we sort of arrayed it against the traditional funnel here. And awareness does tend to be a marketing dominant job, but distribution and network and product have a very important role to play here as well. When we think about a typical regional bank, based on our long time study of the shopper dynamics and the switching dynamics in the category, we know that a typical regional bank will have about a 30% aided awareness, and that bank may be competing against nationals that have 80%, 90% plus in overall awareness. And so branch footprint, product distinctiveness, right, have to come in and compensate for what maybe no media budget on its own is going to be able to solve for you there. And on the consideration side, right, compelling rate and product features do drive consideration, right? That's definitely product and pricing decisioning, but marketing can also amplify that, right? As we get down into the account opening and funding and retention, one of the interesting things we see on the account opening side, particularly for digital account openings, which are increasingly counting for a greater and greater share of account opens, of those who start applications digitally, only about 15% are ultimately approved, right? And so there are choices also in digital experience and decisioning logic and the onboarding handoffs, right? And those are all, intermingled decisions at the customer level that are being made in different silos, operation silos, digital silos, risk silos, right? And that is a challenging statistic to overcome.
Yeah,
Brandon, I can see you want to say something. Feel free to jump in.
Yeah, always. I think one of the interesting pieces there too is we do often talk about this dynamic between branch origination and digital origination. And when you think about particularly the right-hand side that you talked about too, if I were more focused on mass and unit acquisition, that tends to skew you towards digital marketing tactics, which drive more digital channel utilization, which tend to drive the units, but we've still seen this quality gap when we originate in the digital channel. And so we are big advocates that you need to be doing that digital acquisition, but you probably don't want to push folks there. But it does come to this balancing act as well, which is I need to have very clear objectives, and everybody needs to be aligned on exactly what am I trying to achieve through it.
Yeah, exactly. And that just sort of following that thread down to the funding and deepening, right? There is a very small percentage that are bringing 10,000 or more kind of at that point of account opening. And there is an, off us balance opportunity that's very real But activating it is going to require coordinated engagement across those things that Brandon just mentioned, right? And not just a single campaign. That's not what's going to sort of drive the kind of growth that we're talking about. And then on the retention, 60% of digitally originated customers are gone in 12 months, right? And that's not a targeting problem. It is a targeting problem, and it's also an engagement problem and an experience problem that's got to be owned across the entire kind of post-acquisition journey, and thinking about, okay, if I'm sending a whole lot of customers into open accounts digitally or in branch, I better have a very good catcher's mitt from an experience standpoint and an operations standpoint to make sure that I'm catching and seeding as many of those as I possibly can. And I think the call out in blue here on the bottom of the slide is really, the sort of core point here, that we do tend to still think about growth objectives in very siloed ways, right? Each function optimizing for its metric, whether that's marketing hitting CPA targets or product hitting funded account targets, or retention, teams thinking about retention targets. And the problem is the sort of all of those locally rational decisions are potentially generating suboptimal outcomes for the bank as a whole. And that's because nobody is really making decisions at the customer level. Nobody is fully owning that. And getting to a customer first agenda here means that all of these functions have to operate with a shared view of what success looks like. And that's a lot harder than it sounds, and exactly kind of what this session is all about.
Great. So, in Curinos fashion, on the next page, gonna geek out on some numbers for a moment. What we did was we dug into demographic trends at account opening to really look at, so who is bringing the balances, and what can that actually tell us about what we can expect? What's probably not surprising, so what you see in the 6 bars that we have here, the left 3 are less than 100,000 income, the right 3 are more than 100,000 income, and you have the age cohorts within that. So what's probably not surprising is older and higher income customers tend to have higher balances. Great, encouraging to actually see, but not at all surprising. What might be surprising, though, is that bottom row on the table as a starting point, which is what portion of those customers that I'm bringing in actually bring 10,000 in balances or more in their first 3 months on book. And the biggest number on the page in the bottom right is at 24%, which you should be scratching your head and saying, hey, why is it only 24%, right? This cohort certainly has the dollars. In that group, their average balance tends to be more like 50,000, and yet we're only getting about 24% of them to bring 10,000 or more in their first 3 months on book. And so I think the big push here is, as we look at the opportunity, there are a couple dimensions to it. There is one, do they have the money? Do they have the wallet that I'm looking for? Or if I'm focused more on transactions, do they actually transact with debit or credit to the degree that I actually am hoping that they do? But then the second question does have to be, can I actually get them to engage in the right way, which is both a targeting question and an engagement question, as Sarah said, which is, how do I make sure that I'm getting those balances? And I think the other interesting trend here that I just want to highlight, and again, we've made a complex chart, which we can't help but do, but the blue on top, as you look at these bars, the overall bar is kind of the average balance across any onboarding cohort. The blue bar represents how much did they have at 3 months on book. And so at 3 months on book, you'll notice in the 55 plus 100,000, we have 60% of what that average balance over 10, 20 years ends up becoming. You have a lot less growth that actually happens there than you do in some of the younger and lower income cohorts. And so what we actually see when we look at this picture is those are the folks that can bring much higher initial balances. But when we look out over the horizon, we actually see a lot less relationship growth out of those cohorts. And so it tends to be a big focus on what can I bring in the first 3 months and the first 12 months. And then we actually see it stagnate a little bit. So it's really an onboarding function with some of the folks that have the most money, which makes sense because they have the largest relationships, but they're also much more embedded. So they may have a wealth manager and they maintain something over there. They might have a high yield relationship. They may have a transactional relationship. And so you might have a much more fractional primacy relationship with some of those customers. And the time to break that is at account opening. And how do I actually get them across the line to bring more today?
And Brandon, we have a question in the Q&A around, is there a cut to understand what kind of products these balances are in for the first 3 months on book? And I think if we squint at the footnote, we might see the answer, but yeah, good question.
Yeah, so we don't have the breakout here. We do. So if you ping us separately, we can go into that. This does represent the full relationship deposit balances, so would include all of those products within it. The checking is going to be a subset and will be a higher proportion in the lower balance customers, not surprisingly. But we do have that breakout, so feel free to shoot us a note and we can share more details there. Great. So this leads us into the next poll that we wanted to do, which is just understanding how do you measure success of acquisition at your institution? Is it really account open units? Really trying to get as many new accounts as possible? Is it focused on account funded quantity? So how many people actually drove funded accounts, not just a kind of unit accounts? Is it a near-term retained customer metric? So looking after 3 months, after you get through that churn, the people who don't fund or the people who open and close quickly? Or is it really focused on long-term quality growth? So are you looking on a 6-month, 12-month, 24-month basis to understand how those balances matured over time?
I feel like we should have some music playing while we wait for the poll results to come.
Yeah, I was debating what interesting topic I could cover, but I just have been too stuck in the TSA challenges recently, and that didn't feel like a fun topic to talk about. So.
No, waiting for TSA, waiting for my flight is where I am. All right, it looks like we have a yes again on the sort of objective function and the measurements of success, that it really is, we want both long-term quality growth and balanced growth. And then the next big is as many new funded accounts as possible.
Which I think this is encouraging, right? So I think if we'd asked this question 5 years ago, you would have had a lot of folks in that first bucket of it's just a unit game. I think obviously as you go down this list, the measurement time period and complexity goes up a lot. And so that becomes the challenge is how do I balance? I want to optimize now and I want to get smarter and more efficient today with gosh, all of the value really comes from a subset of people. How do I make sure that I'm actually orienting towards that quality picture? And so I think, again, this isn't one where there's a clear right answer. It really is, we should be trying to balance across all of these things. But I'm actually encouraged at how balanced it is. Great. So the next page, just wanted to hit on a little bit is going into some of the dynamics we're seeing within that acquisition cohort as well. So on the next page, what we did was we pulled apart where is deposit growth coming from. And I think as an industry, we tend to talk about, and it's correct, but there is a little bit of this tension between near-term unit focus, long-term deposit growth, and in particular, when we talk about driving deposit growth, it really does come primarily from existing customers. So if you were just focused on growing deposit growth in the next 12 months, you should go first to your existing customers and look at how you drive the growth from that cohort. And we see that drives 75% of the balance growth in a given year. What becomes interesting, though, is as I pull apart that 75%, what you'll notice is more than half of the growth in the existing customers is people who opened their account in the last 5 years. And so as we think about trying to drive material growth over a 5-year horizon, hey, you've got that 25% that comes from the people I acquired this year, but actually over the next 5 years, those customers are really critical to driving deposit growth as well. And so when we talk about this picture of getting acquisition right, it is really critical. It's going to drive the majority of your deposit growth for the next 5 years as you think about the role that acquisition plays. But there is going to be this tension, particularly when you talk about a 12-month basis, of how do I balance my near-term objectives, which might be a funding objective, which are obviously quite important, with how do I optimize for my 5-year deposit growth picture. Obviously, the more I can skew towards low-cost deposit accounts, that's going to drive low-cost deposit growth over a 5-year period that is much more attractive. And this is, again, a balancing act, but it's really critical to understand where my growth is coming from. And new acquisition and making sure that you have that acquisition engine rolling is really, really critical.
Yeah, one of the things I find so fascinating is like how much energy is invested in that 1 to 2 year bar on the right hand side versus the 2 to 5+ year bars. And just it's sort of hit me when I looked at this slide as like, wow, energy devoted to that sort of first, really it's the first 90 days, sometimes it's the first 180 days, and then it's sort of everything moves into quote unquote back book that just gets kind of more episodic treatment rather than sort of consistent attention. So just sort of interesting as we think about the existing customer side of the equation.
Yeah, definitely. Well, and actually on that same note, on the next page, what we wanted to do was really dissect where is that growth coming from. And so one dimension is time, as you talked about, where we tend to have a lot of focus on the first year, but then we don't pay as much attention into years 2 through 5, which actually drive a lot of growth. The other interesting view was we looked at just where does the deposit growth come from over the first 4 years post acquisition. And so looking at post the first 3 months on book and then comparing it to 48 months on book, what we did was we said, actually, all of this deposit growth is coming from a small portion of the population. So the 80-20 rule still applies, and it's not purely based on income. And so the two different color bars here are based on that income. A lot of growth still coming from that less than 100,000 income, but it's a small pocket of that group. And so when we think about our strategies here, getting really crisp in terms of who are the people that can augment their balances and how do we drive treatments that are actually going to drive that behavior becomes really critical. The second piece is, are you missing opportunities in the middle? Are we actually missing some folks that should be and could be augmenting balances that we're not getting to today. And then the retention point that Sarah made earlier, if you look on the far right, that is a very leaky bucket that we're seeing across the industry, which is, your bottom 10%, the folks that are either attriting or just removing balances significantly, that population actually undoes pretty much all of the rest of the deposit growth. And so if you can actually close that leaky bucket, that will actually drive material deposit growth for the institution. And so getting very targeted around who are those folks, what are the things I can do that are actually going to drive me to retain them, whether that's things like relationship pricing, whether that's treatment strategies, or whether that's kind of Salesforce execution of calling programs and other things. There does seem to be a pretty big opportunity to refine that for sure.
And Brandon, as I think about one of the statistics at the top of the call that you mentioned is the sort of many definitions of primacy, the fragmentation of the wallet, and we think about the customers are bouncing around all over the place. We're still approaching solving problems 1, 2, and 3 probably from I have a journey that I am going to have everybody kind of march along, or a rewards kind of stair step that I'm going to march everybody along, that doesn't necessarily meet the customers where they are. And that could be part of the challenge and the opportunity.
Yeah, exactly. And obviously, I would prefer to have those programs in place versus nothing, right? But as you say, particularly as you get beyond kind of that onboarding period, you have a lot more divergence on an individual customer in terms of their needs, what's coming up for them, and therefore that treatment strategy really becomes critical in terms of who should I be talking to and what is the message I should be driving with them.
Yeah, I mean, essentially what you're describing is like this. I think the math, the franchise economic logic of like why we can't stay stuck in this space where it is siloed decisioning around functions or channels, and we have to get to customer level operating modalities that enable us to pinpoint who are that 20% that are going to drive most of the deposit growth over time, and how should I be meeting them where they are at every stage of their relationship, from the early onboarding all the way through. For those that are at the save desk or signaling that they might show up at the save desk soon, right? How do I meet them where they are productively? How do I prevent more from getting there? And then this sort of wasteland in the middle, what am I not doing? How am I not engaging those customers productively? So when we think about what maybe gets in the way of our ability to do that, right? I think most of the banks that we work with are stuck in this messy middle of migrating from product, channel, function first kind of operating to customer operating model. There are kind of three obstacles in the way. And if you jump to the next slide, the first is data fragmentation, right? If you have fragmented data, it means that you're trying to make decisions about customers without a complete picture of who they are, what their context is, what their opportunity is. And it also makes coordination really kind of impossible. And the second piece is coordination and orchestration challenges, I think mean that essentially when you're having a really great decision being made in a silo, that doesn't necessarily mean that what the customer experiences is coherent, and actually meeting them in ways that is going to unlock that value. And then the third is, misaligned objectives mean that kind of every function is optimizing for its own scorecard, And even with good data and good intentions, you can be pulled in multiple directions at once when that's the case. And I think what's super interesting about where we are right now, kind of in the world, right, is we're entering an AI first era, and the complexity that makes that middle column and the right column so very, very hard to manage, because think about all of the intersecting decisions that could be made and impact a customer. Wrangling all of those is at a level of complexity that is kind of impossible for linear management, if you will. And AI, in this AI first era, the right kind of application of that within a decision intelligence engine can solve all three in a single kind of composable platform. So you get connected data and all of the right kind of context for that particular customer, coordinated decisioning, and then a shared optimization architecture, right, that enables you to navigate those trade-offs, and have all of that in a kind of single platform that your clients, that your functions can all work within. And if we jump to the next slide, just trying to, think about what does this look like in real life, right? And this scenario is kind of what that feels like. And in the left-hand side, right, this bank has an objective for growth. And this shows kind of potential siloed collisions, right? When data is fragmented or functions aren't well coordinated or objectives aren't necessarily totally aligned, a product team might set a super compelling CD rate, and bankers mention it and clang the gong about it in the branch, and existing customers might rotate some of their own low rate deposits into it, and the cost of funds goes up, and maybe your net new deposits is not as high as it could have been. And that was sort of a growth initiative that had good local optimization decisions around kind of what to offer at what rate, but ultimately was a growth initiative that competed with the bank itself rather than, really growing. And, nobody made a bad decision. Product did its job. The branch did its job, right? It's the structural lack of view of the actual opportunity, and sort of before anybody's acting, evaluating that. On the right-hand side, this is what happens when you're solving those problems simultaneously. So marketing has context of each customer and understands out of the whole mass, right, which ones are most likely to productively respond here. And that productively respond means bringing net new balances that aren't going to cannibalize, right, and cost you eye-bleeding amounts. And that marketing can kind of make the offer aware to those customers. And, that reaches the right people with the right offer, and your response rates, jump, and you're acquiring real net new balances that you weren't acquiring before. And it's not that you had a better rate, a bigger necessarily budget per se. It was just that the coordination, grounded in customer data, decisions clear around objective function across different functions before the kind of campaign or program launched. And that's really what solving those three problems in one go makes possible.
Yeah, it's one of my favorite examples of, we refer to it as the most expensive marketing, right? And people are going with the left typically because they have very small budgets. And so doing branch collateral and other things is seen as the minimum viable that I can do for a program or campaign. The challenge is that the switching costs, the cannibalization that I drive actually has massive expense for me. And so it actually was a lot more expensive going that route than either one, doing very targeted approaches with existing customers, or two, going out to the broader market where you're going to see a much higher percent new customer versus strictly my existing. Great. Well, that leads us to the next poll question we had, which was just, do you have a blind spot, to activating against customer value? And if so, what your most acute challenge is? Is it really that your data is siloed? So you actually don't have a view of where the opportunity is greatest today, or a holistic view. You actually have some of the data in place, but you lack the orchestration and coordination. You're optimizing against different objectives. So, one group might be focused on units, the other quality, and those are a bit at odds. Or no, we take a long-term view to customer value to drive efficient acquisition.
In which case you're probably not publicly held. Yes. Brandon, while we wait for that, we have another question in the chat, and it says, is there recent data on deposit and retention growth broken down by acquisition via cash offer versus promo rate versus neither?
The short answer is yes. We don't in this document, but certainly ping us. We have seen, so, the cash offer piece has obviously become a really big deal in the market. And we've actually seen pretty good retention rates tied to that. So often the comparison is that versus your traditional, and maybe versus digital. And typically what we see is, the strongest quality and retention is for the folks that went into the branch without any marketing at all. So effectively your organic population walking into the branch. Then the marketing tied to offers tends to actually be pretty good. And then we do see a dip on the digital side in terms of quality. But certainly we see that. And then on the promo rate, that gets a lot more nuanced in that I'll give the favorite consulting answer, which is it depends. But certainly there is some data that we can share on those things.
All right, and let's have a tie on this poll. Siloed data is a big problem, and different objective functions that, it's unity quality or units quality tension, and how do you have better conversations and sort of look around the trade-offs, the corners of the trade-offs right before you're actually taking action, and not making those trade-offs in siloed areas. And then orchestration and coordination is number 3.
Great. So as we look at kind of the path forward on the next page, the way we think about the problem is, as we think about retail growth, you do need to drive the balancing act as you think of near term and long term. And obviously, we would love to be focused on long term that naturally drives near term, and there are those opportunities exist, but they are not always the size that everybody wants, or the budgets that they may have available to them. Then, therefore, it's really critical to get crisp on the strategy. What are our core goals? What are our performance targets? And how do we balance that? And the best way to do this, again, is coming from a bottoms up view. As I think of deploying X, what am I going to achieve there? If I actually did it in a different way, what am I going to achieve? So that you can roll it up and really have strategic conversations. And that strategic conversation could be, hey, we can actually grow deposit growth at 2.5% with the current branch network, marketing budgets, other things. but we're actually going to see a decline in net customer growth. And net customer growth is going to come down by 0.2%, so not massively, but we're basically going to recalibrate our marketing budgets, the way we're going to market, and push towards affluent. And we're going to see that deposit growth, but we're not going to see the unit customer growth. Or alternatively, we can actually achieve 1% deposit growth and 1% customer growth. Or vice versa, we can achieve customer growth, which will help us on a 5-year vision, but actually deposit growth in the short run is much lower. And I think until you can actually have those conversations and get everyone aligned at the senior level in terms of, hey, where do we land on this? If we have these 4 options, which one makes the most sense? Then you're going to have misalignment. And so it's really critical to the easy answer is yes, I want both deposit growth and customer growth. And yes, I want it both near term and long term. But there are going to be trade-offs across those, assuming that you have budget constraints, which most people do. And so as you think of those objectives, you need to make trade-offs. And then that's where we see the opportunity to, how do I think of volume? How do I think about cost? How do I think about quality? And then in order to solve that, you need to be talking about who are the distinct customer segments that are going to drive that. More affluent customers might bring more today, might be more expensive to acquire, and may have less growth down the line. Mass market drive definitely less deposit balances today, but over a 5-year period could be the lowest cost of funds and could actually drive material deposit growth. So how do I balance those folks? You do really need to look at both the markets I'm operating in as well as the segments that I'm operating in and really drive that optimization and those inputs at those levels, right? I need to be able to build a bottoms-up plan that helps me make some clear decisions. So on the next page, one of the ways that I like to talk about this is when we think about the acquisition pool, we tend to think of it in 2 big buckets. There is a marketing-driven component, which typically across the industry, about 20 to 50% of my new accounts are driven by marketing today. That means that I deployed media, I did direct mail, I did digital marketing, and I can either directly or through marketing mix models, attribute it to the marketing that I did. Those accounts came through the door. Those accounts are things I'm actually paying directly for. I should be very targeted and very clear in terms of who I am trying to acquire in that. The other population is organic acquisition. Naturally, people are going to walk into our branches. Our brand is stronger in some markets than in other markets. I may have sponsorships or other things which actually I don't have the ability to move the needle on in the short run, but are going to drive acquisition that happens within the markets. These are 2 different populations that I should think about differently. In the marketing driven, I can be very focused on who I'm going after and what I'm trying to bring from those customer relationships. On the organic acquisition, I still need to make sure I'm effectively onboarding them. I'm deepening the relationship. Again, this population does tend to skew a bit older on average and actually higher income than the general pop as well. And so there's a lot of value to be had out of that organic acquisition, but we should definitely think about these as 2 different buckets because the near-term tactics I can deploy tend to apply to that top group more than the bottom group. The bottom group is all about how I make sure the catcher's mat actually brings in the folks and that I get the full relationship versus the top half, I'm focused on proactive treatments that are going to drive different people through the door.
And I think that's, so interesting really that these two things have to be deliberately kind of thought through with and sort of measured, right? How you're going to actually grow the relationship after acquisition, in addition to bringing the right folks to the front door. And those 2 things have to work together. And the problem, I think, is that historically, these have been totally separate hemispheres, right? That aren't connected. I think solely on that top bucket that's marketing driven about efficiency and getting my CPA as low as possible. And, my organic acquisition, I'm actually, I'm not, it's just more challenging to connect the dots on these two pieces as I'm thinking about measurement and then activation post acquisition, so that that 20% that's going to drive the most balanced growth for me in the first year to 2 years, right? I'm really addressing and engaging with them in the most useful ways. So what we see on the next slide is, right, the two hemispheres. You can jump to the next slide. So as we think about connecting the dots, right, between the targeting that lives in marketing for acquisition and then the sort of the more organic relationship, which maybe lives in branches, maybe lives in digital pricing somewhere else entirely, right? Decision intelligence is the connective tissue that closes the gap between these kind of two hemispheres. And it does that by creating a shared data foundation, right? A shared data foundation and a shared decisioning layer that enables you to make customer level decisions around acquisition and who am I looking for and targeting. Can I have a decoder ring over that prospect population that enables me to parse based on quality or potential quality and maybe stack more impressions against those folks with higher quality markers, bring them into the franchise, and then anybody who's crossed the transom being able to understand and sort of benchmark, am I growing and developing them in all of the ways that I know I could. And that shared data foundation and shared decisioning layer enables the evaluation of the kind of trade-offs that Brandon was talking about between, do I go for quality here? Do I go for efficiency here? Do I go for short term? Do I go for long term? And if you have the data foundation and the decisioning layer in a single thread, you are able to evaluate and look at many possible pathways and sort of make those trade-offs and have those trade-off conversations explicitly before you're actually making decisions and committing dollars. And then the other piece is the ability to see what's come in from your acquisition efforts, in effect, stops acquisition, separation from deepening, right? They stop becoming totally separate strategies and you start to have a customer-centric strategy. And they become kind of two expressions of the same underlying optimization that you're trying to do, whether that's, hey, I need short-term deposits, or no, I want sticky, I'm willing to tolerate a longer-term horizon to get the low-cost balances that I really want. And pricing and marketing and experience stop becoming independent calls on the same customer kind of opportunity. They're all working from the same model of value. And that's what we at Curinos have been very, very focused on. And our decision intelligence engine is very focused on driving outcomes across both of these sides, right? Capturing new customers of high quality, being able to parse who's high quality and bring them in efficiently, and then getting them to commit to the relationship with the bank and drive long-term balances. And that decisioning layer acts at the intersection of pricing decisions and marketing decisions and experience decisions. And if you zoom, if we want to just, okay, that's nice language. what does this look like? What is this practically? On the next slide, just a couple of views on, all of this is managed from within a single user interface that product and marketing and pricing teams can all access and work in together to sort of have those trade-off discussions focused on outcomes in a more kind of customer first and collaborative way. And this is zooming in on the acquisition challenge first, right? Acquiring the right customer. And, what we're looking at here is a workspace, and it's starting with how can I understand at a customer level the opportunity in the prospect world on the basis of quality, right? I've said that deposit quality is what I want to be focused on bringing in most efficiently for in terms of an outcome, right? And so the platform enables you to see at a market level and at a customer level, where are there pockets of high opportunity depositors out there that I might want to go reach. And then it also enables lots of trade-off scenarios around, well, I don't have that big of a budget. Where, if I wanted to go all the way pedal to the metal, what would the cost implication be? If I don't have that kind of budget, what are the trade-offs I would make in the quality of what might be flowing in from a campaign that's not quite as targeted? And then once you've executed the campaign, the platform also enables you to see, how am I doing? What is the quality of what's coming in? How are they seasoning? And importantly, how am I stacking up against kind of benchmarks and benchmark performance on those dollars coming in? So it's that loop that's enabled by unified customer data layer and a decision intelligence framework on top of it that lets you observe opportunity, decide which pathway and strategy and objective function choices to make, and then act in a way where every decision you make is actually making the whole system smarter and smarter as you go. And on slide 20, the next slide, and I'll just wrap up quickly maybe on this one. We, in live deployments, right, against organic acquisition baselines, we are seeing really outsized benefits when you are able to leverage this kind of customer intelligence and activation layer. We see response rates improving 2x, but importantly, balances increasing 2 to 3x as well. So, if you're thinking about it from a CPA reframe, right, if the customers you're targeting in your acquisition are bringing 5x the balances, you can certainly knock on your CFO's door and have a conversation about justifying spend that's maybe significantly more per acquired customer, and be confident that you're still going to improve your payback period overall. And so I'm looking at the time. I think we may pause for any last questions.
Yeah, and we can just land
thoughts
on the next page too, which, I think we've covered throughout, but, generally the key takeaways here are obviously, as Sarah talked about, be really crisp on your desired outcome. Make sure that you understand not just what your objective function is, but any trade-offs that are required as you think about them. You need to get the data into one spot. You want a full view of the customer potential, and that's where obviously we saw a lot of folks are challenged today. And then get really targeted in terms of who you're going after. For the 20 to 50% of my acquisition that's driven by marketing, let's make sure that we're getting the most out of it, whether that's units, whether that's balances, whether that's a combination of the two. But understanding those trade-offs is really important. Great. Well, again, thanks everyone for the time today. Feel free to reach out. We'll continue to monitor the Q&A here as well, but feel free to reach out and we can follow up on some of the other questions that folks had that were looking for a double click or triple click into the data a little bit.
Thanks, Sarah and Brandon. Really appreciate you taking the time to hop on today. And thank you to all of our attendees for taking time out of their day. We will follow up with an email with the recording either most likely tomorrow morning. But again, thank you everyone for joining. The program is now over and you may disconnect.
Thank you.